Hello, my YouTube friends, and happy Saturday. My name is Adam Cotton. This is Investing with Adam K. So, I was listening to one person's videos talking about how nobody's perfect. And then I started listening to Tech Lead going into how he's perfect and started thinking about this thing and realized if you have that feeling that you're not perfect when it comes to trading and you're struggling, well, maybe you're right. And maybe you just have that person that you need to tell you that it's possible you're just lousy at this stuff and you'll never figure it out and should just quit. Now, I hope you recognize that I'm joking. I'm doing that to get people to pay attention and listen along. I've been realizing that over the past 30 or 40 years of trading, you're always learning, always improving. And I've really found that with options, you can really push those revenues, increase your return on investment, and do really well. I don't know if anybody's been watching the past few videos that I've done, but I've been over the past few months really honing down the skills on what needs to be done. And the thing that I've recognized is that you really have to stay committed to your trades. If you sell a put, you have to let it play out. And if it goes through your strike price and you end up getting assigned the shares, you have to adjust accordingly and deal with the outcome from there. You have to give it the time, you have to let it expire, you have to see if you've been assigned shares, if you've had shares taken away from you, and then readjust your position accordingly. And the other thing you have to make sure to do is have the right position sizing on. You can't trade too big, you can't get too excited, you can't push too hard, and you sure can't be impatient. Now, I don't know how many of you watch some of these other YouTubers that talk about 100% return per year, and quite honestly, most of them I don't believe, especially if they're selling their course. Oh, speaking of which, I am going to be selling my course. I'm going to be giving it here on YouTube. Now sit down. You may have to tie yourself into a chair because I'm worried when I say the price. It's such a big number that you may fall out of the chair and faint. And I don't want people getting concussions or breaking bones or doing things and then coming and suing me over it. So this is at your own risk as you wish as you sit there and listen to what I'm going to charge. And it's going to be $0 and 0 cents. We're going to do it right here on YouTube. Um, so I hope you guys are okay with the price, but the only people who can watch further are the ones willing to pay. So stick around if you pay that and send that to me. Just send it by cash in the mail and we're all good. I'm not going to give out my address, so just send it and we'll figure it out later. But if you've been listening to the people selling their courses, and one of them cracked me up because she's charging $5,000 for her consultations, and I just think it's almost comical. On these, you're going to make 100% per year. So good luck to you if you're signing up. I hope you don't need that $5,000 and you can kiss it goodbye. I think you're better off using those strategies I was talking about at the casino. But again, up to you. Either way, when you're using options, pick stocks that you're comfortable owning so that if you get assigned shares, you are okay owning that company. The other thing that I've done that I'm going to talk about right now in this video is I have different accounts for different things. And I'm even expanding to even have more accounts, and I will explain what I'm doing with those. So I have one account that I call it my set it and forget it account. This is my primary account. I don't want to trade. I just own the stocks I want to own. I have it out of possession. In fact, the company I have it with, they don't even allow online trading or anything like that. There's no online access. You have to contact the person to make any changes. And it works like an old-fashioned account where I think it's really cool. I mentioned it in another video too, that one of the things I really like about that is with all the data breaches and everything else, it makes me super comfortable that the information isn't even out there. Like, I like that for that account. The other thing I like is by not being able to make trades or things like that, and it's just companies that I want to own, it stops me from being me because I do like to trade. I then have another account that are companies that are dividend companies. And now what I'm doing with the trading accounts is I'm even breaking them down into smaller accounts where it's trading of each individual equity. So I've been trading Verizon with puts and calls. I started doing it with Conagra. I will probably open up another account for that. I have one for HIMS that I'm going to probably separate it and do its own account for it. And I've also been doing it with SoFi that I will probably have just a SoFi account and potentially even one with SoundHound. Now, I've been doing these all with very small positions and just recognizing that I'm okay if I get assigned the puts, and I'm okay if I get taken on the calls. You still have risks that the markets can move however they move, but what I'm noticing is each one, based on their volatility and the options that you're using, get different amounts of return, and it's really exciting watching it play out. And my whole point about you need to let the things expire is twofold. Now, think this through because I've made these mistakes, which is why I'm sharing it. If you think a company that you want to buy is going higher, so you sell a covered call thinking it's kind of going to get near it and you'll get that money for free, and then you can sell another call. The risk that you take is that the stock just goes higher and blows way above that call price. And the risk and the danger is getting out of that call now just because you think the stock is going to continue higher. I understand that desire. I have made that mistake many times. It's also why you have to stick with companies that aren't set it and forget it companies that you want to own forever no matter what. Like, I don't want to do this strategy with Google or Amazon or Meta, because if I get taken on an option that I didn't really want to sell in a company I didn't really want to get out of because I just want to own it forever, then I might make bad decisions. But if I sold a call in SoundHound and the stock goes above that strike price and I get forced to sell 100 shares, I'm perfectly fine with that. Even if it shoots way above it, because I know with a company like SoundHound, it can have really crazy moves and those types of things can happen. But I have to let it expire and then adjust accordingly. Same to the downside. If I sell a put in SoundHound, which is a really volatile stock for the price, and it's kind of what I like about it. If I sell a put in SoundHound and it drops through that strike price and plummets below it, and I get stuck buying 100 shares at a price that's higher than where it's trading at expiration, same thing. I just have to accept that and adjust accordingly. And the reason I was using those five stocks as an example is they all have different volatilities and really different personalities in terms of how they trade and how they move. What I've liked about Conagra and Verizon is their super low volatility, and even still, in the video I did yesterday, you can really drive pretty significant returns in these very low volatility stocks. What I like about SoundHound is it's trading $14 a share. So now, like always, this is not investment advice. I'm just doing this for entertainment purposes only. You need to do your own research and make your own decisions when making financial choices. Maybe even reach out to your financial advisor. But at least for me, 300 or 400 shares of SoundHound is a very small investment. And since the volatility is pretty high, if I sell a put, percentage wise, I'm getting paid an awful lot of money because of the high volatility in a company like SoundHound. As long as I don't get out of control and start doing it with 5 or 10 puts at a time because I'm just not concerned about the money, it's pretty amazing how quickly a very small position can get really good returns on a company like that. And if I keep my maximum share size to maybe 1,000 shares, I'm not going to worry about it so much. And I can sell pretty tight weekly calls and puts on a company like SoundHound, collect a decent amount of money, and watch that naturally grow. Again, you need to do the position sizing that's right for you. I know that's a super small position, but I'm in no hurry either. So if it takes a couple of years for it to naturally grow to where it becomes a bigger position and I'm trading more options, that's okay with me. And then if I look at one like SoFi, same thing. It's a little bit higher of a volatility than you're looking at for a Conagra or a Verizon. It's got a, when I looked, I think the options trade around a 50 volatility, which is a nice big volatility for a stock that's trading approximately, I think it closed on Friday at $26 a share. Well, I'm not super concerned about getting assigned a couple hundred shares of SoFi, and I've actually traded SoFi in particular a little bit bigger, A, because I got ahead of myself, but B, because it's a company I really like and I want to own the stocks anyway. So what I did with SoFi is I put a little in a retirement account separate from what I'm trading, which allowed me to feel more comfortable to not just sell puts because I think it's going higher and I don't want to lose my shares. But now I also feel more comfortable selling the calls too, because if something comes out and the stock shoots higher and I get taken on all my options and I end up having a very small position, I'm still perfectly happy because I know I have some shares put away somewhere else in a company I really like. But I'm actually trading in companies that I'm not super concerned about owning or not owning because I'm not like stuck on them the way I might be on an Amazon or a Meta. Like I have no affinity towards Conagra or Verizon. And same with SoundHound. Like I've kind of gotten into it just because it's volatile and that's about it. SoFi I have an affinity for whatever reason. I think they're a good company. I like that they sell their products to other banks, and I think from what I've read, they have a decent system that is some real value. But that's why I put some in an account that I don't really pay attention to, and I don't trade any, and then I just trade in the trading account. Now, I haven't put any options on a company like United Health, but to be fair, I did look at like some further out options and thought about maybe I would sell one of a $500 call. And even in the set it and forget it accounts, I might do something like that just because if something goes crazy and goes up a whole ton to where I might consider selling it anyway, to me that is like free money. The stuff that these guys talking about in terms of trading, it is not free money. So now the reason that I've put each of the companies, or I'm actually going to, I haven't set it up yet, into their own individual accounts is so I can be honest about how they're doing. Because another thing with options is it takes time to be able to see if it's working or not. You probably have to commit about 3 to 6 months of sticking with your strategy on them to know if you're profiting or not. Because the stock price is going to move up or down or wherever it goes along the way while you're collecting the premiums of the options. And this is why I like options. I think of a call as people making bets, and I think of a put as people buying insurance. Well, if people are making bets, the people selling to the people making bets is a casino. And if people are buying insurance, they're buying it from an insurance company. The way my brain works is both insurance companies and casinos seem to be doing pretty well selling those things to customers. Most people tend to buy options. Now, I do think that YouTube is creating an industry where people are recognizing the value in selling them. I also think that by going to pennies, it's made it a little bit more competitive. And you can do some research to see the actual volatility of a stock versus what the options are trading at and try to take some advantage when the options are trading at a higher volatility than where the stock is really trading at, if that makes sense. But what I think is in these scenarios, if I am the seller and I'm the one writing the calls and writing the puts, that in some ways I'm like a casino and I'm like an insurance company. And over the long run, by collecting those premiums on both sides, I'll have some losers. It won't go quite right, but in the end, I'm probably on the better side of the trade collecting that money. The other thing I've learned, not just about being patient, is also being more aggressive in the strike prices. For example, I know I talked yesterday about Verizon that I had sold a put and I had sold a call. I had sold a 43 put and I had sold a 45 call. Well, the stock closed yesterday at like $43.97 or something. I had a 44 put that got assigned to me. So I have a couple different options come Monday. Pretty funny since I'm talking about options. Now, I'm going to sell a call against the 100 shares that I've been assigned. That's what happens when you sell a put and you get assigned it. Well, since it's right at the strike price, I could sell a $44 call. Now, I don't know where it's going to open up on Monday. Is Monday open? I know my son said he doesn't have school, but I didn't pay attention to the stock market to see if they're open on Monday. But assuming they're open on Monday, what I saw that it closed at on Friday was 42-cent bid at 44-cent offer. So I can potentially sell the $44 call at 42 cents. And if the stock goes higher and I get taken on the shares, I make those 42 cents plus I guess an additional 2 cents since it closed at 43.98 or wherever it closed. I can sell a 44 and a half call, which looked like it was 22-cent bid. Now, here's where you have to do a little bit of math and decide what you want to do. It's 20 some odd cents cheaper, and you get 50 cents more if the stock goes higher and you get taken on that call. So you're really only profiting an additional 30 cents. As a percentage, if I multiply that out annually, it's a significant difference, but you're not really making the full additional 50 cents if you get taken on that option. You are taking on more risk to hope that the stock goes higher and it sells at 44 and a half versus selling the 44 call and hoping that the stock closes above 44 and you make those 40 some odd cents. And you also have this risk that the stock just goes lower, and no matter which call you sell, it ends up out of the money, and all you take in is the premium from selling the call. So it's not like it's an automatic winner all the time. I do look at the premium as percentage return on the trade, and it's why you have to manage the position size and be careful and wait through the end of the week. Because what I've also noticed is a lot of times, more than I realized, a stock will go through a strike price. It can get significantly below that price, and then it can come right back up and close above it. For example, I don't own any Apple. I haven't for a long time. Well, I sold a $232.50 put for this week, the one that just expired, figuring I'd be happy to buy 100 shares of Apple if it dropped a little bit. Apple went all the way down to like $227 a share as of like Thursday. So I just assumed I was going to get assigned on that option. I didn't do anything. I didn't make any changes. Well, it closed yesterday at $234 a share. I never got assigned on the put. It blew right through my strike price. It went significantly lower. It was even significantly lower the day before it expired, in my opinion. And on the day of expiration, rallied right back up and ended up not getting assigned the shares. I did collect the money for the premium of the put. And in the past, that was one of the mistakes I used to make. Either I would change my mind and decide it might be going lower and I would cover it and I'd lose the money from selling the put at a dollar perhaps and now buying it back at like $4 because I was worrying about the ups and downs of the market. Now I really just wait for Friday and see what happens and adjust accordingly. I assumed I was going to get assigned those shares, and then I would have sold a call above that $232.50 strike price at whatever price and taken whatever I got for another option. And then I just multiply that out per week to figure out what the annual return is and try to get what I'd like to get on that trade. Again, you run the risk of a stock just trending in a direction. If Apple just keeps going lower, I now own 100 shares and you can do very poorly. I know these guys who talk about there's no way that you can lose and it's guaranteed and whatever else, but they're just full of stuff, you know. Try to keep it PG for everybody. Now let's talk a little about each stock that I picked and why I picked it and the position size that I'm comfortable being with and everything else. And I'll start with Verizon, and maybe I won't talk about all of them, but let's talk about Verizon a little bit and why I picked it. Well, Verizon was one of the stocks that I just have in the dividend account. And when I looked at doing it with Conagra, I thought, man, this works so well with Conagra that's such a low volatility stock. I wonder how the numbers look with Verizon. I was pretty surprised to see they look pretty good with Verizon as well. Well, Verizon, what I like about them is tend not to really go anywhere. They've sat in a range for a pretty long time, in my opinion. And then when I looked at the price that I get for a put, even though it's not a lot of money annualized, about 12 or 15% return over a year to sell a put in Verizon. And same with the call. And then you're getting the 6.5% dividend if you're not getting taken on the calls and you own some shares. All of that sounded really cool to me to be able to take a stock that I just bought because I was happy to get the 6% return and possibly even double or triple that return. So, me personally, as long as I have around 1,000 shares or less of Verizon, that is a comfortable position for me. I'm okay if the stock continues to drift lower or if it starts drifting lower because originally I was buying it anyway just because of the dividend. Well, based on getting assigned 100 shares, it moved me from having 300 shares to 400 shares. I've sold one call at 45. I am now going to sell another call on Monday if the markets are open on Monday. And I am short a 43 put and a 42 and a half put. So, worst case scenario, I will end up having 600 shares if the stock just drops and goes lower. which gives me room to be able to sell an additional four puts if I wanted to, or an additional two for the following week if I find out by next Friday after the close it's trading at $42 a share, for example. And it allows me to sell up to two more calls if I wanted to. I do want to have some position on. I don't want to have some huge position in Verizon, but wow, what a way to be able to drive additional return without putting on a position that I'm too uncomfortable with or turning it into some huge trade that I don't want to have on, and just be able to have the position I wanted anyway. So that's why I've started using options on a company like Verizon, and same with Conagra. Now, SoundHound was in the news one day and I looked at it and I kind of thought, that's one I could buy 200 shares and maybe I get really lucky and it shoots to a million. There are those companies out there. I tend not to put those trades on because I usually feel like it's a waste of money. But then again, I started looking at the options and I was able to get 40 cents. I'd have to look and tell you guys which one it was, but I couldn't believe that I could get 40 cents for the call and like 30 some odd cents for a put for a stock that was trading about $14 to be able to collect 70 cents with only risking taking on another 100 shares. So that's a lot of value to me. So this week, I know I sold a 16 and a half call because it had traded up above 15 at one point. I don't remember what I got paid on it. I'm happy to look and tell you guys if you really want to follow along on the trades and see what I'm doing. But keep in mind, I watch a little too often. And what I like about the option strategy is this is something that anybody could really do and sit down on a Saturday or Sunday, look at the stocks they want to trade, put their orders in for Monday, and then go to work and not look back again until the weekends or 2 weeks out when things expire and adjust accordingly. Like that's kind of what I like about this trading strategy is a person doesn't really have to pay such close attention to the markets. Now, they do have to do their research. They have to pick the companies they like. They have to be comfortable with buying more shares if they're selling the puts at the levels they're selling it at, and they have to be comfortable being able to sell shares if the stock goes up to where their strike price is on their calls. And I can really walk through it step by step if any of you want me to. So by all means, in the comment section, if you're a little confused what I'm talking about, I am happy to break it down like that. And like I said, the course only costs $0 and 0 cents. It's I think that's pretty reasonable. Uh, I I hope nobody fell out of their chair. Now, don't get me wrong. If you start making tons of money and you want to just send me money because you're so happy with the stuff I've been explaining, I'm okay. I'm not above any of that. I'm okay to accept any gifts or things of that nature. But as much as I'm half joking, I think it's a good strategy. And what it allows people to do is do a little research on the weekend, go to work or whatever it is they do during the week, wait for the week to complete, see where things are and where they expire, and if anything's changed in the position. And if things haven't changed, maybe sell the same calls and puts again. And if things have changed, adjust accordingly. Like I said, I got more aggressive on the Verizon in terms of the call that I'm probably going to sell. I typically look to sell a 45 type of call and a 43 type of put, but I had a 44 put on because the stock was a little bit higher and I got assigned. I actually sold a 44 call because it fell down to 42 something, and that was when I picked up an additional 100 shares and sold a 44 call anyway. Being assigned the shares makes me very comfortable to be really aggressive with this call that I sell because I almost hope to sell 100 shares so that the position doesn't continue to grow and get to be too big a position. That's kind of my point of I've gotten more aggressive with the strike prices, that I'm not trying to just make a little by let me my hands are going out here. But I'm not just trying to make a little by selling a put that I don't think I'll get exercised on and a call that I don't think I'll get exercised on. I actually want to get more of a premium and I want to buy 100 shares if the stock drops lower, and I want to sell 100 shares if the stock goes higher and make additional money, even if it's only 50 cents or $1 from the stock move. Same reason, because when I do that out annualized, it becomes really good returns on a company like Verizon. And I still don't see it moving really big in any direction unless some news comes out or unless it's earnings time. And the other thing that I'm doing is I'm trying to have as many options expire before earnings date when volatility goes higher. And then I will sell more options and take advantage of the higher volatility. But I want to be able to make that decision the week before the earnings, because what I've noticed is the volatility tends to go the highest at that point, which is why what I talked about yesterday as well is you have to pay attention to when the distribution date, the ex dividend date is on a stock, and you have to pay attention to when the earnings dates are. Because the ex dividend date, the stock price is going to drop. It is going to impact the price of the options as to when the ex dividend date is. Calls will seem a little bit too low in price and puts will seem really high. So you have to pay attention, because if they're giving a 50-cent dividend and a stock is trading at 44 on X dividend date, it should drop to 44, 43 and a half. Now, it never works perfectly, and markets are markets, but that is what's supposed to happen in terms of the math. So if you're looking at the options and the price doesn't make sense, take a look to see when the ex dividend date is or the earnings, and that might be what's impacting the prices of the options. So that's what I've been doing with Verizon. It's been working out incredibly well. It's also been working really well with Conagra. SoundHound is really new. I only started it with a couple of weeks ago. And HIMS, you guys saw the video on trading HIMS. That's been very exciting, which had a great week so far. In fact, HIMS is another great example about being patient and just letting things play out. I was short some 45 puts in HIMS, which if you watch the older video, you'll see, and it'll have the dates and everything else, primarily for September 19th. And I have a 40 put as well and some in the 30s that I'd sold, and it blew through the 45 strike price. And I assumed that by the end of next week that I would be getting assigned at least the 200 shares from the two puts that I was short at 45, and I think I have 240 puts as well, and I assumed it might go through 40. Well, meanwhile, HIMS has gone right back up. It's trading $55 a share where it closed on Friday. It's volatile enough that I have no idea what's going to happen this week. But fortunately, and partially thanks to you guys, because by doing these videos, it's forcing me to be more patient and let things play out. Did I just let it do whatever it did? It blew through those strike prices. It looked like I was going to get crushed on those puts, as well as the position that I have on. And lo and behold, right back up. Now it's at 55. If it happens to close next weekend at $55 a share, all of my puts and calls are going to expire worthless, and I'm going to collect all that premium and be in the position, if I want to sell more puts, to do so and possibly sell more calls. Now, when I looked at it, I am long 1,000 shares. I have 4 calls expiring. That'll leave it to where if the stock goes higher, and I'm fortunate enough to get taken on the other calls, that I would still have 400 shares left. And I kind of like HIMS, which is why I picked the company, and I think it's one that could go ballistic. So I'm not sure what I'm going to do yet, if I'm going to sell more calls on it. I just like collecting the premium on it. So I want to sell the calls, but I don't want to get taken on all of the stock. In fact, that might be one that maybe I put 100 shares into my retirement account or something and have a small position in case it does go ballistic, just so that I know I own a little bit, and then I can be more aggressive on the calls I'm selling. So the key takeaways are position sizing and being committed to the trades you put on, and being okay where, I guess that's a third one, being okay with what happens. If you sell a put on a stock at 40 and it drops down to 35, you have to know that that's a risk that you can take on and that you were happy to buy that stock at 40. Are there stocks you guys are looking at that you're curious how it works out? I don't mind taking a look and seeing what the volatility is, and maybe doing a video to talk about what I would do. There'll be another huge charge for that, probably the same price as the course. So keep that in mind if you're asking. Um, but again, I wouldn't do it with companies you just want to own, because if you're selling a cover call and it goes right through that strike price, and you get filled and end up not owning a company you just want to own, that can really suck. So I tend to put those in a separate account, leave them alone, and never look back. The other thing is, know that trading has real risk with it. You're gonna have ups and downs. It's gonna be a more volatile, like the stocks or whatever. You're gonna see bigger swings in either direction. What I try to focus on is how much I'm collecting by selling the options more than what's going on with the stock price. So, for example, I think my average price on HIMS is about $53 and change. Well, HIMS dropped all the way down to almost $40 a share. To me, mentally, that's a big swing that I have to not pay attention to. And what I focused on was how much money I was collecting just from selling the calls and puts, and knowing that I could continue to do that. Now, as it's gone back up, I understand that mentally it's nice to see that, but I still have the same desire of my goal is to be able to sell $1,000 or more of options every month in HIMS. Because the way I look at that is if I have 1,000 shares and I can sell $1,000 of options every month, that's $12,000 a year on a $50,000 investment. Now, since some of them are puts, I have to calculate that added on to the trade if I get assigned on those. So it's a little bit more money. And I know that's a huge number for a lot of people. I don't want it heard the wrong way. I don't want to come off as like, oh, you just make millions of dollars. I worked a lot of years very hard. I was a commodities trader. I've been very fortunate, and it's put me in a position that I can afford to take that kind of risk. If you're not, please, by all means, it is not financial advice. Do not take the same type of risk if you're not in the position to. But just know if you sell a put and you get assigned those shares, the stock could continue to go lower and it could go against you. You have to be okay with all of that. And in the trades, like I said, I'm getting tighter on those premiums. I take a company like HIMS. If I can make that type of return every month consistently, I'm not worried so much about where the stock's actually trading. Mentally, when it's down, I see it in red. It is what it is. And when it's up, it's green. It feels better. But it really doesn't matter. The real goal is, can I drive those returns by selling options every month? And if I can, then I feel like I am making $12,000 a year and the price of the stock is just whatever the price of the stock is. And maybe I can grow the account and start to get more aggressive, but I recognize for myself, I started out a little too aggressive. I'm much more realistic on Verizon and Conagra about the position sizing. And you guys can learn from my mistake. Even though, as I said in the beginning, I'm perfect and I don't make those mistakes. So, it is what it is. Anyway, do me a favor if you haven't already, hit that subscribe button, smash the like button, put some comments. Do you guys like the options discussions? Do you want me to be more regimented where it really writes down the numbers and goes over specific? Or are you okay that I just kind of ramble? I'm not promising I'll do what you ask because, I do this for fun and for me and whatever else. But I see my little swim reminder that it's time for me to wake up my son and get ready to take him to swim. And I like doing that stuff. So have a good day. I'll do the editing while I'm at swim. They have great Wi-Fi, so it's a great place for me to kind of sit down and play with the video. Have a great weekend. Maybe I'll do a video tomorrow. I'll definitely do some this week, and I'll talk to you guys soon.